All right. 3, 2. Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for May 22nd, 2022. I don't know about your kids, but my kids are getting out of high school this week. It's come quick. I know some people, go on probably like for another month, but man, my kids are going to be home. That means I need to go grocery shopping for the teenagers. Anyway, I hope you guys and gals are having a great weekend. It's been obviously very busy the last couple of weeks. A lot of volatility. And you know what? If you would go back and look at this year at the exact same time, we were praying for volatility. Now we've got volatility. We got what we wanted, and it's great. It's bringing a lot of really awesome trading opportunities for all of us in all markets. And I know whether you've been on the right side or the wrong side, at least we've got volatility, and that is a good thing for traders. I'm going to get right into the charts. So let's just hop into it because, there was first of all, there was an Australian election this weekend. I'm going to talk about currencies here in a moment, and I am going to talk about stocks really quick because obviously we've had a very big drawdown in equities. I'm going to talk about a couple of the different indexes here. I am going to talk about currencies. I'm going to talk about what's happening this next week. I'm also going to talk about some crypto because I want to see what Bitcoin's doing and Ethereum, but before I get into all that, make sure you guys subscribe to the channel. If you like this content, you like what we do every week, give us a thumbs up. It's not just giving me a thumbs up. I'm really looking at it from my team's point of view. Over the weekends we put together these videos. If you like them, make sure you subscribe. All that jazz. All right, thanks everybody. All right, so let's take a look at the S&P. First and foremost, and most of you all know that this has been a chart that's been on my radar for months. I thought that this was developing probably at the beginning of the year. As we were selling off, I'm like, yeah. I just had thought originally that the neckline here, that break, because we had it drawn kind of like this at the time. I was like, yeah, that seems like a little premature. So I didn't get sucked into, on the short side of risk back then because, it looked like a false breakdown. But now, we've really shown the market's true colors. And, the overall bearish intent of this head and shoulder pattern really is like 3,500. It's somewhere down here. So I just want you guys to keep that number in mind as we make it through the next, let's just call it 6 to 8 to 12 months. Does that mean that the head and shoulder pattern is going to complete, here in the next week? No, probably not. Matter of fact, in the next week, I think we're more set to rally than anything. But I just wanted to point that out, that over time, that's probably where we're going to go. And if you think about, like, those of you that listen to our daily, here, let me just show you really quick, our daily shows and that we have set up, the F.A.C.E show, the Forex Flow show, those are free. And we, if you listen to my analysis throughout the course of the week or from our team, my point of view here is that with the equity markets, I feel like we're going to be in a range for a long time. And I felt that way for probably the last year and a half. Like, at some point we're going to peak. And then once we do that, which it looks like we're doing, we're going to be sideways for a long time. So this is going to be more of a range trading environment for many, many years. All right. So I wanted to point out this particular chart on the S&P, because if you take the low to the high, you'll notice that we are at the 38% retracement. Now, that also is a big deal because if you take the high to the low where we were at this week, we were down 20%. And we closed, let me just double check my numbers really quick, but we closed the week down 20%, flirting with it. I mean, we're basically down 19%. So we were down a little bit further on Friday. We rallied back. People got a little freaked out at the end of the day. We snapped back. But I want to point out a couple of technical things here on the S&P before you get all uber bearish. First and foremost, I do think that we're going to have a bit of a recovery. Divergent relative strength is, one of my tells right now. And then also everybody's extremely bearish. It's, you even have some late night talk show hosts talking about the meltdown in the markets and cryptos and blah, blah, blah. So that stuff is, it resonates with me because it's like, okay, everybody's talking about the stock market. Everybody's talking about the possible bear market. When you start to get that sentiment, I start to get a little worried. When you're looking at a market and you have like a COVID spike down, the market went down for a reason back in 2022 or 2020, excuse me. That sell-off was so fast, so swift, and, we were melting down due to the COVID, lockdowns. Right now, the stock market is actually correcting. So in a correction, in a very long, extended multi-year. Here, let me get rid of this because this is from last week. I should have deleted that, but that doesn't really matter. You go back to last week's week ahead video. We've been climbing for 13 years straight, basically since 2009 to where we're at right now. We are going to correct. And we're probably going to be, if you've listened to these week ahead videos, you've heard me say this before, we're probably going to be in a long-term trading range for many, many years. And when I think about many years, I'm probably thinking more like 5 to 10 years. We're going to be in some sort of range environment. You guys have heard me say that before, and it's not new news to you. But that's good. If you're a trader, that's really good. If you're a long-term investor, you got to think about that. When you're at lofty levels, you might want to change your allocations as we get down towards more reasonable levels in the market. You start thinking about putting your, money back to work, things like that. But talk to your financial advisor. That's not me. All right. But I'm just giving you my opinion. And I think we have 13 years of a party. We're going to have a long hangover. I mean, it's like, you're out drinking all night, literally drank like a bottle of tequila. You're going to feel it for the next few days. Well, in the S&P, when you've been partying like literally for 13 years, we're probably going to have a hangover for a while. I mean, that's just, we have to redigest unless, something crazy happens. It's if the markets are just going to stay sideways, probably just do, normal due course in equities. But you see that, you got stocks like the S&P the NASDAQ, we've come off quite aggressively. And you see a lot of longer term, here, let me go do this. You see a lot of stocks, and I'm not talking about the major averages, but you've seen a big beatdown on a lot of names. You are going to get value players coming in and starting to find stocks that they find of value. But one thing that I've learned over the last 25 years plus being in the markets is in situations like this, funds are looking for companies that actually make money. That's the important thing, and we're going through earnings season right now. You've seen a lot of the big names get smacked down like Target and Walmart. But once the dust settles, everybody's going to be looking for companies that are making money. And at these valuations, the PE ratios are much more attractive than they were 6 months ago. So just think about that. And then you take like the index like the Dow. Dow has also had a pretty big move, and just realize that we're coming towards the breakout point. And whenever you get towards a breakout point, you're getting close to support. That's the bottom line. And you can see in the Dow, also 38% retracement. It's got a little bit more room to run. So are we out of the woods yet? No, but I think you got to start being a little bit more careful with the market in general. Let me get rid of this box really fast. Now, what I was pointing out here is you have relative strength divergent, and you can see relative strength is actually starting to move up now as price moves lower. That's usually a tell that the markets are probably going to have some sort of consolidation or a, quite possibly a bounce. Now, am I looking for a very big move in equities? No. I mean, if we get a move back to 4,100, and everybody should know this, at least if you listen to me on a daily basis in our free shows, that the 4,100 is kind of like that line in the sand. You're below 4,100, you're bearish. You're above 4,100, you're going to get a squeeze. And so right now, we are bearish while we're below 4,100. We pivoted off that like to a T, and we've been talking about that number for weeks. But if we get above it, sure as heck, you're probably gonna, I shouldn't say that because really I don't know, but I would think that we're gonna get probably a healthy squeeze, maybe back to 250, maybe back to 4,300. hell, maybe even to the 200-day moving average. You got to think about what the Fed's doing here. And the Fed is, even though that they looks like they're dead set on raising rates, half a basis point for the next two meetings in June and July. The thing is they could start coming forward with more dovish rhetoric. It doesn't mean that they'll act that way, but if you start hearing the doves come out, that could be the catalyst that actually gives us a little bit of a squeeze. Like I said, do I think that the market's going higher from here? Near term, I think we could bounce. Long term, we're going down to sideways. Near term, if we get a bounce, you probably want to use that bounce to sell into strength. I can't see us at this point in time, based on the information that we have, that we're going to make it much more above the 200-day moving average. But could we squeeze back up there? Sure. But let's take it one day at a time. And I think as traders, we have to do that. We have to take it one day at a time. So let's go into currencies. Let's talk a little bit about what we've got in the markets, because the euro, I have to say, Euro's holding this low from 2017, that spike low back in January. We're holding to a T, and we are nudging right up to the 106.30 level, which is this, it's like 35, 37, depending on what feed you're looking at. That's the spike low, post-COVID spike low. Now, if you are a believer, not in Justin Bieber, but a believer, not a believer, some of you might find that funny. If you got teenage kids, you'll find it funny. Anyway, if you're a believer that the Fed might be more dovish moving forward, but the ECB has to play some catch up, they might still be hawkish, which you see the ECB members are coming around with really hawkish rhetoric as of the last week or two. What you're probably going to see is you're going to see that divergence in central bank rhetoric spur some sort of short covering rally in the euro dollar. And if we get above 106.30, 106.40, there's a good chance that we squeeze back to 108. I'm showing you a weekly chart right now, but that's kind of where my head's at right now. I am talking my book because I am long some euros. And some long some euro dollar, short the dollar currently. Again, if you're listening to the live shows that we do for free during the week, you already know that I'm positioned short the dollar right now. But that is kind of the way I'm approaching the market at this moment. Fed's going to take their foot off the gas pedal with their words, but other central banks are going to step it up with their words. So that divergence, or convergence rather, in central bank expectations might give us a little bit of dollar weakness moving forward. Speaking of which, let's talk about the Australian dollar. So most of you might know that I'm already selling some dollars, buying some Aussie dollar at cheaper levels. Now, Australia just had an election this weekend, and Scott Morrison, after 9 years, their party out, Labour Party in. I was reading a statistic. 15 days after federal election poll dates, the Aussie dollar on average rose by 1.3%. I'm reading. In 8 of the 11 federal elections held since 1990, the Aussie rose in the 15 trading days after the polling date. After the poll date. Now, here's the thing I want to say about the Aussie dollar. Everybody should have seen that the 70-cent level is really big. I'm also looking at this more long term here. Let me just, I guess I could, this is a weekly chart, so you guys can really see kind of what my ideas are here on a weekly basis. Look, I don't think the Aussie dollar is going to parity anytime in the near future, but I do believe this is a long-term basing pattern or reversal pattern or head and shoulder pattern. You guys should have known that as of last year, late last year, the thing that I was looking to do in 2022 is to buy the Aussie dollar sub 70 cents. I bought it last week and the previous week below 70 cents. I happen to be long Aussie dollars going into this weekend. Now, if you look at the daily chart, we are well above 70 cents. And if we squeeze much above 71 cents, here, let me draw this trend line here. And I just gave you kind of the data to back this up. Doesn't mean past performance is indicative of future gains, but I just gave you the statistic. Let me read that again. In the 15 trading days after the federal election of poll dates, the Aussie dollar on average rose by 1.3%. I'll read it again. The second sentence, in 8 of the 11 federal elections held since 1990, the Aussie dollar rose in the 15 days after the poll date. So, technically speaking, if we get above 71 cents, which, by the way, here, let me do a little bit more work for you. Let me remove that fib, and let me take the high from the 200-day moving average rejection, right? You can see it right here, to the low right here. The 618 comes in at 71 cents. Oh, also at the trend line. So if we get above that trend line, guess what? Probably going to get a little bit of a squeeze. Now, you may not be an Aussie bull. You might be an Aussie bull, and you think this is the low, generational low that we're seeing. Well, my opinion is you can trade it and see how we react once we get to the 200-day moving average if we start squeezing a little higher. But I think the stars are aligning that it might happen. Now, if you take the Kiwi dollar, you'll notice that the Kiwi dollar hit the 161% extension of the last rally. We held that support and we reversed. Now, the Kiwi also has an inverted head and shoulder pattern. Now, the reason why I mention all this is, obviously we're pivoting off the neckline. Here's your right shoulder, here's your left shoulder, here's your right shoulder, here's the head. Okay. Now, that has a little bit of room to move and squeeze, because I would assume that at this point in time, everybody's like very short the Kiwi after a, I don't know, what is that? Nearly 800 pip move lower over the course of the last 2 months. So, if we get a bit of a recovery back to previous support, which should act as current resistance right here, right? Previous support should act as current resistance. That would be the inverted head and shoulder pattern target. What else is happening next week? Wednesday morning in New Zealand, Tuesday evening, in North America, really late at night in Europe while you're probably sleeping, the RBNZ is expected to raise rates by 0.5 basis point. How about if they have some hawkish rhetoric after that? How about if we get a hawkish hike? Well, then the risk of the Kiwi dollar making it from 64 cents to 65 cents is really quite good at that point. Right now, if you take that into combination with what the Aussie is doing, and if the Aussie does start to squeeze and the Kiwi starts to squeeze as well, then you get the Antipodean currency starting to rally at the same time. So let me stop here for a second. Let me say, guys, if you like what I'm doing here, and gals, if you like, I don't want to exclude the ladies, if you like this analysis, please give me a thumbs up. Also, let me tell you the sponsor of this video. It's us. It's Forex Analytics. So make sure you try Forex Analytics. It's $1 for 10 days. You can then jump in our community. You can see this is our trading community. You can see how active it is. This is just Friday when it's actually really quite slow. You see charts. We're talking about the markets. That's just the general chat room, not even to talk about the trades room where we're posting all of our different trades and what we're doing in the markets. You can even see I'll post my positions open. My positions right here, and you can see what positions I'm even trading. Now, why is that all a great, all of this great? And by the way, this is the Flowonomics room where we're talking about macro ideas and what's happening in the markets as everybody's saying goodbye for the weekend. But we have so many different chat rooms. But why is this so important? Well, it's important because if you try the trader funding program and you want to try to access larger amounts of money, because maybe you don't have access to larger amounts of money, or you don't want to trade your own money, you want to trade ours and keep 75% of the profits, well, then take an assessment. We have a very small assessment fee, and then you can try to paper trade and make 10% without losing more than 5% on a maximum trailing drawdown, or 4% intraday. If you can make 10% and not hit one of those two breaches, well, guess what? You'll access the larger trading accounts, and you get Forex Analytics and our community, and you have unlimited time to do it. That's the kicker. Take your time. We're not going to handcuff you and say, oh, you got 22 days to complete this assessment. No, we don't work like that, because we want you to succeed. We will give you Forex Analytics for free for a certain period of time based on what assessment that you're taking. So this way you can be in the trades room. You can be with other like-minded people and understand like what people are looking at, what they're trading, and help you along your journey with, qualifying for a larger account size. If you want more information, just click the video down below. Just watch the 2-minute explainer video. You see me there in my office. Just go ahead and click that and check it out. All right, that is it for our public service announcements. Let's get back to analysis. So next week, we talked about what's happening with the Kiwi, what's happening with the Aussie. There's a lot of data that's coming out next week. I am going to take a look at cryptos. I am still going to look at the dollar index, so don't worry about that. But I want to cover just a couple of things that are happening next week. So next week we have European PMIs early in the week. We have, like I said, the RBNZ. We have Fed Chairman Powell. He's speaking at an American Indian Enterprise Development luncheon or something. We have Kuroda speaking. We have Christine Lagarde from the ECB speaking. We have durable goods orders, which is going to be really important to watch durable goods. Everybody's really now starting to focus. You got inflation, but also we're all focusing on what's happening with the economy, making sure the economy is still sputtering along with all these very high prices, right? That's important. Then we have Canadian retail sales. We have U.S. preliminary GDP, which people are going to be watching carefully because we want to know if we're heading into a recession with high inflation, which equals stagflation, which most of you know that. Then, to wrap it up, at the end of the week, my opinion, probably the most important data of the week is on Friday. We have the U.S. PCE data, and that's really, really high-level inflation data that the Fed's going to be watching. So, and then we have University of Michigan consumer sentiment and inflation expectations. I know it's only a 5,000 person survey, but that's a decent sample size. Just taking the heartbeat of America and figuring out, hey, are you guys still worried about prices? I can pretty much guarantee you they are. So all that's happening. So how's the dollar going to be affected? Well, we've been looking at the dollar index, and everybody knows that the dollar index right now, it's at risk. We came out of this channel. You can see that channel. It's in the dotted lines. We are now below, or right at, let's just call it right at, the post-COVID lockdown spike highs from 2020. The dollar index is actually sitting on that number. Now, everybody that listens to here normally already knows that I'm very laser focused on this 2017 high, 2020 high, the low from actually, here, let me fix that. The low from 2 weeks ago came in right at 102.30. My opinion is, as long as we're above that 102.30, you got to be very careful with the dollar. However, we break below 102.30, you're going to have false breakouts. You're going to have, really sentiment probably turn sour technically in the dollar pretty aggressively. We might actually see the dollar, sell off a little bit. So when I start thinking about the euro 108, yeah, 108 is possible. 110 is even possible. All right. So anyway, those are some things that I'm looking at with the dollar index. Last but not least, we have to talk about Bitcoin. God, where is Tom Brady when you need him? He's there to win all of his, Super Bowls, but then he marches out Giselle, his wife. Some of you don't remember when she said, I only want to get paid in euros as a model. If you don't remember when Giselle said that, here, let me get rid of this too. That would have been, let's go over to the euro dollar. That would have been right about here, I want to say. Maybe end of 2007, beginning of 2008. That was near 160. The euro is near parity. Now, I don't want to say history will repeat itself here, but I think she was on TV with Tom Brady talking about cryptos right around here. I don't know exactly what date it was, but it was around the Super Bowl, right? So that would be actually right here. Wait, right here. Right here. Okay. Now, you guys know, for those of you that listen in daily, I'm a crypto blockchain. I'm a blockchain bull. I believe in the technology. I believe there's going to be a lot of cool stuff that happens with blockchain. I believe we are going from cassette tape to DVDs in the financial markets. Or VHS to DVDs. Did I say that right? Maybe we're going from DVDs to digital storage. I don't know what we're doing, but what we're doing something like that. That would be the analogy that I use. And I don't know what the technology is going to be that leads the way. Is it going to be VHS or is it going to be Betamax? I don't know. So I do believe technology is going to be moving forward, and I believe that the financial markets are going to be in a digital form, especially, they're already there and moving forward for the next decade. It's going to be important. Who are going to be the winners here? I'm unsure. But I will tell you this much. Bitcoin right now is breaking down. And a lot of people are targeting 20,000, which is natural. I mean, that's the breakout point. Everybody thinks 20,000. That's where we're going. I get that. But I also know that Saylor, I always want to say Robert Saylor because I know Robert Saylor, but it's not Robert Saylor. It's Michael Saylor, right? I know he's got a big micro strategy, but his averages in Bitcoin are what, 21,000, 28,000, something like that. Look, when you're in a bear market, it just takes down everybody and everything. And, when you're in cryptos and you're in a bear market, that probably is going to happen too. So many people are targeting 20,000. I think we either do one of two things, and you've probably heard me say this already before, but we're going to stop shy of 22,000 because there's just 20,000 because there's so many buyers there that we're just going to bounce somewhere around there. And or we're going to eventually break through 20,000 and we're going to just destroy, decimate the market, and we'll end up consolidating somewhere above 10K, and then all of us that sit around and wait for the pieces to be on the floor, we'll start picking them up. So it's unclear to me what exactly is going to happen, but what I will tell you is Bitcoin doesn't look good at this moment, and Ethereum doesn't look good. And until Bitcoin gets back above like 35,000, 37,000, somewhere around here, maybe even 38,000, until we get above those levels, you got to play defensive. And and I'm going to leave it with that. So guys, gals, if you enjoyed this, I hope you have. And by the way, if you're not listening to our shows every day, we actually launched a new one called the Flow Show. Ryan Littlestone and all the European team members from Forex Analytics, they're on there every morning now. Register. It's free. You can get prepared for your trading day. And if you're in North America or you're in Europe and you want to get prepared for the North American session, come join us in the F.A.C.E webinar. It's not just myself, it's the team as well. Plus, we have... oh, no, that's not it. We have a new website that's set up for the F.A.C.E experience, which I don't know where it's at right now. Oh, it's right here. Here you go. And check out this website, the F.A.C.E experience, which is cool. You can see who we are, what our team, who the teams are that are on the analysis every day, and then the testimonials of some of the biggest names in our industry on Dale and what we do here at F.A.C.E. So come join in. It's free. This way you're in a community, as you should be. All right, guys and gals, my name is Blake Morrow. Thank you so much for joining me today. Thanks for spending your very valuable weekend time with me. I'll catch you on Monday morning on the F.A.C.E webinar. Have a great one. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.